Hello and welcome. You're watching ET Now Spotlight and my name is Alex Matthew. Now, this week's focus is sugar, and that's because changes in the government's policies with respect to the sweetener are likely to have massive implications not just for the sugar industry but also for farmers, for oil companies, for automakers, as well as the government's own finances. And all of that has to do with ethanol, which is also called ethyl alcohol, which is essentially a type of alcohol. Take a look. To say that India has a sweet tooth would be a major understatement. The country is by far and away the largest consumer of sugar in the world. It is, after all, the home of jalebi and gulab jamun. But India is also the second largest producer of sugar, accounting for about 20% of global production. And because of that, despite India's insatiable hunger for the sweetener, in 4 out of the last 5 years, it has had a sizable surplus of sugar stock. In the ongoing sugar season, that is October 2020 to September 2021, it is estimated that India will produce close to 31 million tons of sugar. Consumption during the year is estimated at 26 million tons. Part of the reason for the substantial increase in production over the past few years is the emergence of Uttar Pradesh as India's largest producer. And that has to do with the adoption of a new strain of sugarcane called CO0238 in 2018. The new variety led to a substantial increase in sugarcane yield per hectare, and in fact, the yield in a couple of short years rose over 30%. And the higher quantity of sucrose in this sugarcane led to higher recovery by mills as well. What's more, support provided to farmers in the form of minimum support prices and state-advised price in states like Uttar Pradesh made it more lucrative to produce sugarcane than any other crop. Now, India has in the past exported a large part of its excess stock. But because of the higher price of sugarcane in India, prices of sugar are not competitive in the global market. As a result, the government has to support sugar mills by providing an export subsidy, which in turn helps protect the farmer. In 2019-20, the subsidy was fixed at 10,448 rupees per ton. It was moderated to 6,000 rupees per ton in the next year, and recently, starting the 20th of May, the government announced that the subsidy would be reduced further to 4,000 rupees, partially because global sugar prices have risen over 60% from their lows over the past year. That's still a substantial burden on the exchequer, considering that India exported nearly 6 million tons in 2019-20 and is expected to export another 5 million tons this year. And that's why the Modi government has decided to take a leaf from Brazil's book and boost the production of ethanol. Also known as ethyl alcohol or green alcohol, ethanol is used in several countries including India, along with petrol, to reduce the consumption of crude oil. The aim is to utilize excess sugar on an ongoing basis to produce ethanol. This will ensure that surplus stock is not wasted, the government's subsidy bill is curtailed, and its import bill is reduced over time. In other words, the farmer benefits, the sugar mill benefits, and the government benefits too. Clearly, a win-win for all involved. Now, the government's ethanol policy has undergone massive changes over the past couple of years. My colleague Karishma Asudani has been tracking it right from the start, and she's put together a report that talks about the timeline of events and also where things stand right now, what the government is asking automakers to change to facilitate this change of policy.
Well, the Modi government has reinvigorated its ethanol blending policy, which had been dormant since early 2000. The government is looking to promote ethanol as a blend stocked with auto fuel under ethanol blending policy since 2018. Ethanol blending policy envisaged an indicated 20% target of blending ethanol with petrol by 2025 and a 10% target of blending by 2022. In fact, government recently also advanced the timeline of 2030 20% target to 2025 and has further advanced it from 2025 to that of 2023. This will majorly help oil marketing companies to sell E20 as early as from April 2023. Oil marketing companies currently also have contracts for supply worth rupees 325 crore, which will help in achieving the 8.5% blending target by year end. And this will of course progressively add up to achieve the 10% target by 2023. Well, not just this. In order to increase production of ethanol in the country, the government has also introduced a tripartite agreement between banks, oil marketing companies and sugar mills in order to extend financial support to them through loans and schemes. Government is also in a dialogue with the auto industry in order to increase ethanol blending with fuel. In fact, they also have set a target an ambitious target to launch E100 vehicles on road with flex engines. Well, this is government's plan on its mega ethanol blending program, which will help in, of course, reducing the expensive and high crude imports and will also help in reducing air pollution in the country in the near future.
It certainly seems like the perfect solution to quite a few problems. You increase the production of ethanol and you hit not two, but three birds with the same stone. But there are challenges involved and a few hiccups that might hinder that 20% blending target for petrol and ethanol.
The production of ethanol is tied to the making of sugar. Sugarcane goes from farm to mill and is crushed to produce juice. The juice is then clarified, concentrated and crystallized to make sugar. The molasses that remains after this stage is called B-heavy molasses, which is further processed to generate more sugar. After this stage, what remains is called C-heavy molasses. Part of the policy change introduced by the government was to allow production of ethanol using B-heavy molasses and sugarcane juice. Earlier, only C-heavy molasses was used to produce ethanol. And in order to encourage higher ethanol production, the government introduced a higher price for ethanol produced using B-heavy molasses and sugarcane juice. It also incentivized the creation of distilling capacity by providing an interest subvention of up to 50% for any ethanol capacity addition. According to the Indian Sugar Mills Association, OMCs will be able to procure enough ethanol to hit 8.5% blending with petrol in the year to November 2021. The advancement of the 20% blending target to 2023 will need a significant ramp-up in ethanol production. And all of it is unlikely to come from sugarcane. The government is exhorting mills to start using other grains to produce ethanol.
अभी तक इथेनॉल बनाने वाली ज्यादातर इकाइयां और ज्यादातर 4-5 उन राज्यों में ही थी जहां चीनी का उत्पादन ज्यादा होता है। इसका विस्तार पूरे देश में करने के लिए जो सड़ा हुआ अनाज होता है, निकम्मा हुआ अनाज होता है, उसका उपयोग करते हुए फूड ग्रेन बेस्ड डिस्टिलरीज की भी स्थापना की जा रही है। एग्रीकल्चर वेस्ट से इथेनॉल बनाने के लिए भी देश में आधुनिक टेक्नोलॉजी आधारित प्लांट भी लगाए जा रहे हैं।
The advancement of the target to 2023 will still need a significant ramp-up of ethanol production. And all of it is unlikely to come from sugarcane. The government is exhorting mills to start using other grains to produce ethanol. The primary challenge the Modi government will have to overcome is not in the creation of capacity to produce ethanol, but in the logistics involved in handling it. Nearly 2/3 of India's sugar production comes from 3 states: Uttar Pradesh, Maharashtra and Karnataka. If petrol blended with 20% ethanol is to be sold in areas that produce little or no ethanol, it would require the setting up of a logistics network to transport ethanol to OMC depots. Industry sources say that this may prove to be a challenge as sugar mills are unlikely to take it up unless they are adequately compensated. Now, having said that, considering that these states account for a large chunk of India's vehicular traffic, the government could well achieve a significant portion of the blending target even if it focuses on just them.
Let's now talk about the automotive sector. A higher blending target for oil marketing companies is all well and good, but if the auto companies do not transition to a technology that will facilitate that higher blending, well, it might just not take off at all. I'm joined now by Hormuz Surabji, the editor of Autocar India, to understand the perspective of the automakers. Now, Hormuz, thanks so much for taking the time. I do want to understand, automakers have been buffeted quite a bit. They've had, on the one hand, a new fuel policy to deal with. They've had the electrification movement to also contend with. They have been hit by the COVID-19 pandemic, and now they've been told that you need to develop technology that will allow for a shift to a higher blended fuel. How do you think that they're going to react? Are they going to be agreeable to this?
Well, this is exactly what causes a lot of stress, a lot of issues in Motown, because to suddenly spring these kind of directions or mandate a certain technology, it's just not feasible sometimes. Now, looking at going from BS4 to BS6 as it is, it nearly broke the back of the industry. We are still seeing the effects of that. The effects are really, the growth rates have gone down in the auto industry. A lot of it can be traced back to these, sudden regulation changes which are just thrown, and manufacturers are forced to comply. Now, obviously, I think the goal is genuinely good, but I think there has to be an understanding that in the auto industry, technologies, you need to give a really long lead time. Firstly, mandating technologies, that also is questionable. You just need to set the norm. That's what most people do. And then how you meet that, you can choose the technology. But, coming to this, it's not as much of a serious jump as it is to go from BS4 to BS6. I mean, the engines are fundamentally the same, but they need to be recalibrated. The fuel lines, all the a lot of parts need to be changed, because ethanol is highly corrosive, and especially in this almost full concentration, it will create issues. The engines will have to be calibrated, so that's fine. But I think there are other issues as well. I mean, is there going to be enough ethanol production? That's the question we need to ask. So you're forcing the two-wheeler industry to go full ethanol, but will there be enough ethanol production? So frankly, I've just heard this news from your channel, so I'm a little actually taken aback by it. I've not heard it from anywhere. So, but I assume that this is the direction they're going. But 1 year to go from 10 to 95, it's actually just very difficult. I don't think it's feasible. I think what they had said for the car industry is to go from 10 to 20. That's more practical, and then you would have an overlap with regular fuel also, because don't forget, the older cars also are on the road. They're not going to go off the road very soon, and if they, without their engines being modified, use ethanol blends, there could be problems for the cars as well. So yeah, quite a lot of issues over there.
Now, Hormuz, I do want to ask you about the E100 vehicle that was launched by TVS. There weren't many takers for it, and what I'm essentially wondering is, does simply launching the technology work? You would also need to have a guarantee of the fuel availability.
So I think, to be honest, that's how it's gone with electric vehicles also. Let's be honest, everyone's done lip service to the technology, because again, with the same thing, the two-wheeler industry was told within 5 years, you've got to go full electric. Which is crazy. Obviously, that's been rolled back on. I don't know what next. Maybe after a month they'll say you have to go full hydrogen. I wouldn't be surprised. So I think this is really, I would say, actually even it has to be thought through. You just can't be springing these technologies without understanding the implications of it and without understanding the feasibility of it. And I have to say, the ethanol, the case is good because number one, it lowers your oil imports, which is a big issue for us. But who knows whether 5 years from now, the oil might come back down to $30 a barrel. So then, we can't predict that either. And of course, I think it's a big boost for the farming sector. So I think that would really be good. But I don't know how much they could scale up to produce the required quantities of ethanol. But the challenge is again for the consumer, because typically ethanol, it doesn't have the density or the calorific value of hydrocarbon or regular petrol. So what that means is it's not as efficient, and you tend to lose around 30% efficiency using ethanol. So unless ethanol is at least 30% cheaper than petrol, frankly, to the consumer also, it doesn't make any sense. So all this needs to be thought.
Thanks, Hormuz, for putting all of that into perspective. We'll have to wait and watch to see what auto companies do over the course of the next couple of years. Now, there's no doubt that there are challenges, but sugar companies are certainly enthused. In a conversation with ET Now just this week, Vijay Banka, the managing director of Dwarike Sugar, talks with optimism about the improving situation with regard to the demand-supply dynamics in the sugar industry. Take a look.
Government has been continuously working on ensuring that the overhang of the stock is addressed. And on a long-term basis, sugar companies are able to sacrifice sugar production in favor of ethanol. So that the ethanol blending program has got the right impetus now, and we see going forward a lot of capacities being added. And in the times to come, maybe 2 to 3 years down the line, we may be able to see a happy situation where the sugar production is equal to sugar consumption. And thereby the overhang of stock issues are addressed. We should see a reasonable stock levels of about 3 months or so stock holding as at the year end of the season. So all these augur well for the sugar industry in times to come.
Let's delve a little deeper into some of the factors that are influencing the sugar industry right now. Joining me to put everything in perspective is Pratik Tolia, the AVP of Institutional Equity Research at Elara Capital. Thank you so much, Pratik, for taking the time. Somehow, it seems that a lot of things, or rather everything, is falling into place for the sugar industry suddenly. It seems like the sector is waking up after a decade or so of slumber. Is that really what is happening, or is there excessive optimism that is currently being seen in the industry?
Hi Alex, thank you so much. No, I don't think there is excessive optimism. I think, yes, definitely the sector has woken up, but this has primarily been driven by a lot of policy changes right from 2018. I think May 2018 was when the ethanol blending policy was announced by the government, and that has really led to this entire change that we are seeing today. I think it has got a slightly delayed. I was expecting this whole optimism to have come 1 year prior, but somewhere I think it got a little delayed in terms of announcement of new capex for ethanol. I think last 6 months is where the real momentum we've seen gathering at the policy front, and that's where the capex of ethanol has also started coming in, and therefore I think the optimism is for real, and we are pretty confident that the momentum will continue in the coming years.
There are estimates that say when you talk about a 20% blending target, then you're talking about a requirement of approximately 1,000 crore liters of ethanol. It would be incorrect to expect that the sugar producers will benefit the most from this higher blending, right? What is the capacity that is currently being put in place and the monies that are being spent by the sugar companies? How do you see that panning out over the course of the next, say, 3 years or so?
Yeah, so I think sugar companies will be catering to almost 70% of their blending targets. I mean, the blending requirement, like you rightly pointed out, 1,000 crores. 70% will be coming from the sugar industry. And in terms of the capacities that are already on stream, around 500 odd crore liters, we should be ready by end of this year. So, which means that's, I'm talking about the installed capacity, and so 400 crore liters will be what we can produce out of that. And beyond that, I foresee at least the kind of announcement that have already come out from the, especially the private sector companies that we normally track, that are the listed ones. So they are pretty much, talking about putting up another 20-30% of, from the existing capacity. So we should be somewhere around 600-700 crore liters in next 2 years' time. And by 2025, therefore, government also seems to be pretty optimistic. And based on the way things are progressing and the kind of announcements that are coming up, the industry, based on my interaction with the industry guys, they are pretty confident of reaching to that 1,000 crore liters of total capacities and 700 to 800 crore liters of capacities only on the sugar industry.
The enthusiasm in the sugar space has been reflected by the price increases that we've seen in the listed stocks. And what kind of increases we've seen, right? We've seen doubling, we've seen a couple of stocks rise as much as 3x over the last 1 year or so. Is there still significant value, according to you, to be found, and which are your picks in the sugar space?
Yeah, I mean, if you talk about stock specific, clearly, the sugar sector as a whole, the listed space has, as rightly pointed out, become 2x, 3x in a year's time. And it is, mainly driven by the whole ethanol story and also the price stabilization in the sugar space that we are seeing. So, which is helping them to, make decent profits in sugar. And the ethanol business is now going to become a bigger part as more and more capacities come on stream and the companies are, putting up additional ethanol and the margins over there are better. So, if you look on the EBITDA front, for most of these companies, the EBITDA contribution from ethanol, which used to be in the range of 10-20% earlier, in fact, some were not even having a substantial ethanol capacity or very minimum. So these companies which had 10-20% EBITDA contribution from ethanol are now we are talking about something around 60 to 70% of your profits coming from the ethanol segment alone. And sugar, which used to be 80-90%, will become only 40% or even 30% for that matter. So clearly, the EBITDA mix is changing. EBITDA mix is changing more towards a segment which is more profitable in terms of EBITDA margins. The cash flows are much superior over there. The working capital requirement in ethanol is very low because the OMCs are paying you back in 15-20 days. So all those factors definitely warrant a much higher multiple for the distillery business alone. So if you talk about average EV by EBITDA, which the sugar sector has traded over the last 10 years, when your sugar contribution was higher. So we are talking about something around 8x EV by EBITDA over the last 10-year average. So currently, if you look at these companies, they are trading at 8 to 9 times EV by EBITDA on 1 year forward earnings. So if you go ahead and if you start if you look at the fact that EBITDA contribution from sugar is only going to be 30-40%, and the larger chunk of profits comes from ethanol. So therefore, we expect the multiples for because of the ethanol business to be much higher, and the company should trade at least 12x EV by EBITDA going forward. So this is almost a 50% jump on the valuation front for all these companies. So they are today at around 8-9 times. So at least I think a lot of upside is remaining for most of these stocks. Especially you have to be careful that which are the companies that are putting up new plants, because that is really going to shift their EBITDA further towards ethanol. So broadly, I think our top pick obviously is Balrampur Chini, followed by Triveni Engineering. So these are two companies which have been putting up big plants. They have already big sugar capacities. Balrampur is already cutting down on some of the sugar production and moving towards more of ethanol. But they are further going to increase their ethanol contribution towards the profits. So clearly, these companies warrant much bigger multiples on the EV by EBITDA front. And therefore, there are significant upsides still left for the investors in these names.
All right, thanks so much, Prateek, for that insightful chat. You've certainly put a lot of things into perspective. Now, this ethanol policy is also benefiting ancillary businesses, particularly when it comes to setting up of capacity. I spoke to Manoj Baheti, who's the founder of Carnelian Capital Advisors, and here's what he had to say.
For creating 1,000 crore liters of ethanol capacity, we require a capex of anywhere between $3 to $4 billion. Out of that $3 to $4 billion, like it translates to close to 28,000 crores. Out of that, 50% kind of thing which is addressable by players like Praj. So 14,000 crore kind of opportunity, addressable opportunity size comes to Praj, and Praj having almost 60% kind of market share. So over next 3 years, like 60% of 14,000 crore, almost 8 to 9,000 crore kind of additional opportunity can flow to Praj. And if you look at the current revenue run rate of Praj, it is 1,000 to 1,200 crores kind of thing. So with such a massive jump in the capex cycle, I think Praj kind of player will immensely benefit over next 3 to 4 years on account of this capex cycle.
The ethanol policy shift may just be the last crucial piece of the sugar industry puzzle. There are certainly more calls for a re-rating of the sector, and stocks have run up dramatically already. Having said that, a lot of people are saying that there is more steam in that rally. We hope that we've given you a deeper understanding of the sugar industry and all the factors that are at play therein. That's all we have for you on this edition of ET Now Spotlight. Do stay tuned. This is ET Now.